Recording's on. Thank you, Darlene. I forgot all about that. Thank you. Let me go back to where I was. All right, here's our Blackboard week 4. And in there is a file folder right at the top called week 4 in class spreadsheet. There's a file there, week 4 in class work. If you can download that, we're going to be filling that out this first hour of our class, doing a financial analysis for that company. So if you can download that, bring that to your screen and work on it while I'm working on it, that would be good. If you cannot do that, try to work on this off class like tomorrow or the weekend and see if you can put this together. It's a spreadsheet, download it and try to fill it out. All right, I'd like you to do that. In regards to that, let's make sure we bring back up my spreadsheet. And here we go. Okay, so this is Lozano Chip Company. They make microchips. And this is a company where I've given you their December 31st balance sheet of assets and liabilities. Now I've dropped a couple of zeros on this to make the numbers a little bit manageable. But when you take a look at your companies next week, in your case number 2, those numbers are going to be quite large. So you have to get used to that. The companies that you selected are all major American corporations. So you got to remember that. So here's the balance sheet, the assets, the liabilities, and equity for this Lozano chip company. Also is the income statement for December 31st for the year ended December 31st, 2019. As you can see, they made $113,021 in profit. What we're going to do with this company is we're going to determine do a financial statement analysis. And then once we do that analysis, then we're going to talk about the strategies that analysis will tell us about the company and what they should do. What are the strategies? And one of the key determinations of the strategies is look at this column right here, industry average, the industry average column. That's telling how their competitors are doing. I'll highlight in that yellow. That's how their competitors are doing. The industry average is what their competitors on average are doing in regards to those different ratio analysis. So what we're going to do now, we're going to spend about 20 minutes, 15 minutes. I'm going to shut up, and I would like you to determine, remember we're using the page 119 in your text as a ground for the calculations, the equations. Also remember, we talked about this last week with that sample we did last week in class. I'd like you to take a few moments to calculate the current ratio and these other ratios for this company as of December 31st. Take a few moments, download that spreadsheet, or even on a piece of paper, try to determine the current ratio, days sales outstanding, that's a new one, the profit margin, return on assets, debt to assets, debt to equity, and the return on equity. A couple of new ones thrown in there. So I'm going to be quiet. I'm not going to put on the music. I'll just be quiet. And I'd like you all to try to calculate these ratios, these 6, 7 ratios on your own, and then we'll go back through it. I'll do the calculations. I'll do the formulas in the cells, and then I'll post this back to Blackboard. But you're going to have to do this same thing next week in case number 2 for your company. So I'm going to mute my microphone and see if you all can put together these ratios from chapter 3. And we'll come back in about 20 minutes. And don't stress or don't get worried if you don't have the capabilities of answering these, calculating these right now. Don't worry about it. I'll do the calculations. You can learn from that and study them. Just do the best you can. Okay, I have put my calculations on the Ouija board here, and we can review them. And what do they mean in relationship to the industry average? These are a variety of different indicators of liquidity, asset management, profitability, and debt management. All determinations of the company's performance for a period of time relative to the period of time in the performance of their industry. And what does that say to the managers of the company about how they're running their business, and are they competitive and efficient in that business? So let's take a look at these. First of all, the current ratio. The equation is current assets divided by current liabilities. It's telling us the relationship of what we have in assets that have a life of less than 1 year compared to liabilities that we have to satisfy or to pay in the next year. That's what current means. Another way of also talking about this is also working capital. Current assets and current liabilities are basically called working capital. Companies need working capital. They need a, a safety net between what they have in liquidity, assets, and what they have to pay out. If they don't have that working capital, it can choke a company in 2 weeks flat. So this company is on par with the industry average. They're pretty well, the other competitors or the industry are basically running and are about as liquidity as they are. So that could be a good thing. The usual rule of thumb in business is your current ratio should be anywhere between 1.25, 1.25, and 2.25. Any higher than that means you might have a receivable or a collections problem, or too high of an inventory, or too much cash where that cash should be invested into some higher types of longer term assets. But generally speaking, 1.25 to 2.25 is the general rule of thumb for most businesses. As you can see here, their current ratio is pretty well on par with the liquidity ratio of their competitors. But then it's a different situation in days sales outstanding. What does this mean? How long does it take them to collect their receivables on average? On average. So what the calculation is there, as it's taken from page 119 of your text, is you take the end of the year receivable balance and you divide it by the average daily sales for every day during the year. In other words, their company's sales were $7.5 million. There's 365 days in a year. You take 7.5 million divided by 765, that's how many sales we make on average every day in this company for every day of the year. We divide that daily average into the receivable balance on December 31st, and we find that it takes us almost 77 days on average to collect our receivables. Now, again, in the real world, what they usually do is they take the January 1st receivable balance, take the December 31st receivable balance, and take an average of that, divided by 2, and then you get your average receivable balance during the year, and then they put that into the equation. Page 119 in the textbook says, we'd rather take the December 31st balance and do our calculations. Different ways of doing that for some businesses. But what it still means, no matter how you did it, is this company is double the time that it takes to collect their receivables. And that is a problem. That's 77 days from the time we sell our product till the time we get the cash. That's not cool, all right? The industry average is about the average of all companies, about 35 days. 30 to 35 days it takes most businesses to collect their invoices, their receivables. This company has a collections problem. Now, could it be that they have deadbeat people buying from them? Could they be that they have a very poor and inefficient receivables operations of collections? Could it be that their customers are dissatisfied with their products, so they're taking their time paying it back? Those are all strategic questions you need to ask to find an answer for that. Thomas, you got 76.65. Boy, you are a stickler. If I take this out to another decimal, there it is right there. You are right on, okay? I just kept it within a 1 decimal point, but if you want to be specific, no problem, okay? I like that. Either way, notice whoop, 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 or as the textbook answer says, whoop. All right, so either way, you're fine. So that's how we do that. Good, thanks, Thomas. You did good. You just round it. I'm just rounding it on my spreadsheet to different types of decimal places. No big deal. But the big deal here is if I had this company, and if you see this, if I give this to you on case number 2, and you see your company have a pretty ugly, by the way, in case number 2, I will supply all the industry averages. You don't have to worry about that. I will give you the industry averages for your company. I don't want you fishing around doing research, spending all your time trying to find the industry average. So do not worry about that. I will provide that in the case study. I'm making a note to that right now because if I forget that, you're going to yell at me. So this company has a problem. And that is a major issue with their strategies. They have to take a look at what's causing the problem of they take so long to collect their receivables. Michelle, go ahead right now. What's your question about industry averages?
It could have waited till later. It's just that I was kind of frustrated because I was looking for several of those numbers on the industry average for the case study, and it was kind of all over the place. And I was just wondering if maybe later on you could just tell us where the easiest way.
Industry average for case study number 1?
Well, I was doing some extra stuff.
Oh, okay.
And I was looking for industry averages.
Yeah, so I'll have an exercise a little bit later on when we come back from break. We're going to go to the library website and take a look at a database that helps us find those things. I'll show that to you. Okay.
Okay. Thank you.
Okay. Thanks, Michelle. Okay. So let's take a look at profitability, profit margin. That's a pretty easy one. I'm sure most of you got that one. It's net income divided by sales. 113,021 divided by 7.5 million. In other words, 1.5% for every dollar they sell, they're making a penny and a half. All right, that's basically what that is. And notice the industry average for their industry is 1.2. They're doing a little bit better for profitability, not much better, but they're still at least equal and more than the industry average. Their profit margins are in sync with the industry they're in. So that's a good thing. Return on assets is the next profitability indicator. That's net income, 113,021, divided by the assets of the company, 4,275,000. I get 2.6% return on assets. What that means is for every dollar of assets that you've invested, how much profit is coming off those investments as a return. Remember, the sole reason you purchase assets is to give you a return on the investment in that asset. That return's got to be great enough to meet the interest or the cost of that capital that you got to get that asset and give you a significant profit. So their return on assets was 2.6, their profit margin of 1.5, basically 1.1% of that return went to pay off that asset, the return, interest expense, principal payments, whatever. That's a kind of a quick and easy calculation. They made 2.6 on every asset invested, but they declared a profit of 1.5. Where did the difference go? To pay off that capital, to pay it off. The last profitability indicator is return on equity. This is very important if I'm a shareholder. What is my invested capital in the company returning as profit? So that number is 113,021, our net income, divided by our equity position of the company, 1,752,750. And we're making a return for our equity holders basically stock and stockholders, 6.4%. That compares to the industry average of 9%. So here's an interesting strategy to look at. Their profit margin is comparable with the industry, but their return on assets and return on equity are a little bit below the industry average. That tells us a couple of things. It tells us that their costs are maybe a little high for their money, their cost of capital. And it tells me that their stock, the amount of stock in the company and retained earnings is not matching what other companies are increasing the value of the equity position of the company. But mainly it tells us that the company is making profits, they're doing okay, but what is that share in the different types of ways they can get capital? Debt, equity, assets. How those returns are generated is the profitability indicators there. A lot of investment analysis looks at return on equity and return on assets for many companies. That's an important thing, and we'll be looking at that down the road. The last indicator is an interesting one. It's the relationship of debt to equity. And all right, remember the capital structure of a company. I'm going to type this in here. The capital structure of a company is equal to the assets plus the liabilities plus the equity. That's the capital structure of a company. Assets are, assets are plus, assets are equal, there we go. Assets are equal to liabilities plus equity, the old accounting equation, all right? That's the capital structure. In other words, the capital structure is what debts and equity are funding assets, all right? When we get into chapter 9, we're looking at what this cost us, debt and equity. That's our cost of capital, what it cost us to get the assets. But here, what is the relationship not only to assets, to liabilities and equity, which is the capital structure, but what is the relationship on this right-hand side? What is the relationship of debt to equity? As usually the indicator is, most companies have more debt than they do equity, usually. But when you start having debt getting so much of the capital structure of the company compared to equity, you start looking at leverage problems. You start looking at bankruptcy problems. You start looking at you're over leveraged. So in here is this company, the debt to equity is the relationship of debt. Now I'm talking total debt. Oh, I'm sorry. Let me go back to your, I'm sorry, I'm jumping ahead. Let's go to debt to assets. Excuse me. Yvonne gave me the evil eye, so I know I was going too fast. So debt to assets, the relationship of debt to assets. And now there were a couple chat questions about this. In the textbook, they use the total debt to assets ratio as total debt to total assets. And that's what I included here, the total debt of current assets plus the total debt of long-term debt divided by the asset base of the company. It ends up being 59%. But in many circles, and I do mean many, they take only the interest-bearing debt as part of the debt to assets, interest-bearing debt. What is interest-bearing debt? Notes payable and the long-term debt. You do not include accounts payable and accruals, all right? Because that's not interest. You pay that in 30 days. Notes payable, that's the current portion of the long-term debt, but it's interest-bearing. So usually the debt to assets ratio in many circles is the interest-bearing debt divided by total assets. And if you do it that way, you get what, Yvonne? 33%, I believe. 33?
Yeah, I mean, so for your total debt, what did you use when you got
I used total current liabilities plus long-term debt.
Okay, and
I took, if you look at my formula,
okay.
I took 1,453,000 plus debt long-term. That's the total debt position of the company.
Yeah.
And I divided it by assets.
Okay.
So in my opinion, both ways are right. Seriously.
But you get vastly different numbers.
Yeah, but you get different numbers because you're throwing out in your calculation, the 33%, you're throwing out the current liabilities.
Okay, so for a case study, do you want us to do it your way?
No, I will tell you in the problem how I want it, okay?
Okay.
Now remember, this is an interesting point, Yvonne. I'm glad you brought it up. Remember, and we've talked a little bit about this in this class. This class is interpretation. This class is how you see the numbers and how you interpret the numbers. Yvonne might see it as 33%, just including the interest-bearing debt. Mr. Hassey might see it as the total debt. Thomas might see it Yvonne's way, whatever. I have no problem if I have in the solution 59%, but if you have 33%, I know you're right as well. So either way is fine, but in the question, I will probably designate which way to do it, okay? Because
Professor?
that way is going to be able to match what this number is calculated on, okay? The industry average. So it'll be comparing apples to apples, not apples to oranges.
Professor?
Yes.
Can I ask you a question? Okay, I used exactly the same numbers you did and came up with a totally different answer. I did the formula exactly how you did it, and I came up with 14.54%.
For
I used
debt to assets?
Yes, I took total, I took the I'm sorry, I took the current liabilities plus the long-term debt
Mm-hmm.
and then divided it by the total assets, 4,275,000.
Did you put the 1,453,500 and the 1,068 into parentheses?
Yes.
So you did it exactly this way. Equals
Yeah.
1,453,500 plus 1,068,750 parentheses divided by 4,275.
106,875,0, 4,275. Oh, wait a minute. Oh, I changed it. No, you're right. I did get 59%.
Very good.
But yeah, the debt to equity, I didn't. That was a
Right.
different.
We're going to look
Okay.
at that one right now. Okay.
Okay.
Thanks, Michelle.
Mm.
Okay. So let's, so again, so Yvonne and Alice, I think you also questioned that. So 33% is fine, and that's the correct way. There's a different ways of interpreting that, okay? And you will be designated that if you do get that in a question, okay? Good work. Now let's look at, again, we were talking about the capital structure. We were talking about debt to equity. The debt to equity is the relationship of, let me move this over so I can see my work, is the relationship of debt to the equity position of the company. So just like I did in debt to assets, I took the total current liabilities plus the total long-term debt, and I divided it by not the assets, but by the equity position of the company. In other words, debt is 144% of equity, all right? In other words, it's that relationship of debt to equity on that right-hand side of the capital structure. That can tell you a lot of things. That the larger that number is, oof, there's not much equity supporting the asset base of the company, and it's mainly in debt. At the same time, it also tells you the relationship. Now, again, Yvonne and Allison, that you are also right. You could also just take the interest-bearing debt in this calculation and compare it as well. If you do that, it's just simply taking out the accounts payable and the liabilities, adding notes payable to long-term debt and dividing it by 1,752,000. Either way is fine. All right, it goes back to the debt to assets discussion. So either way is fine. It's just telling you the relationship of debt to equity, not debt to assets. But if I ever show you, if somebody shows me a company that's near bankruptcy, that means they're highly leveraged. The debt to asset relationship could be 200 to 300%. The debt to equity relationship. Could be 200 to 300%. In other words, debt is hugely over what the equity position of the company is. That's a company near bankruptcy, company that's highly leveraged. So that gives you an indicator about that relationship with the company. So that coupled with some of the equations we looked at last week, that gives you a pretty good idea of what I'm going to be looking for in your case number 2 next week. Now, when we come back from break, what I'm going to bring up is I'm going to bring up a database in the Wilson Library where we can use to look at industry average, where we can use to look at how some of these numbers are calculated for our specific companies that we selected. Now, I'm not going to pick any of your companies, but I'm going to pick another company along that ballpark, but also some of the ways you can do that. Now, one of the things you do not have to worry about is I will provide the industry averages for you, okay? You do not have to worry about searching for yours. The thing that you have to worry about is, are you able to read the financial statements, financial statements of your company? Now, that could give you a very good heads up. Since we only have a discussion post for this next week, before next week, if I were you and I was a student, I would go ahead and find the financial statements for my company, Home Depot, Nike, American Express, 3M, Microsoft, Johnson & Johnson, Boeing, Walmart, and Coca-Cola. Hey, see, I did my homework. All right. What I would do in the next week before case study time next week is go ahead and find those financials and begin maybe to print them out or get familiar with them. So when Mr. Hassey gives you the case next week, you're ready to roll and understand where you have to look for some of this information.
And Professor,
yes,
you
Yvonne.
have to use the most recent, obviously.
It's going to be probably December 31st. Yes.
Okay. Okay.
I wouldn't use March 31st because some of you might not have that data. So I would use December 31st or whatever the fiscal year. Like some of you might have a company that's fiscal year is not December 31st. It might be another date. So we'll have to take a look at that by company by company. But if you have those questions, you can always ask me. So when we come back from break, you're going to see on your computer screen the Wilson Library website, and we're going to look at that and see how we can use that. Some of you already might be familiar with it, others might not, and I'm going to show you how to use that. I am now going to save this spreadsheet and insert it into Blackboard so you can use it as a study tool for financial statement analysis. All right, good job. I'm glad you guys were able to calculate some of that information. Let's take a break, and when we come back, we'll in about 10 minutes. Let's make it around 7. Let's make it 7:15. 7:15, and we'll come back at 7:15 to take a look at our library website. Okay, see you then. Okay, I'm back. I am back now in my office, not my library or whatever that was. Now I'm back in another location, as you can see. Let's make sure everybody's back. Let me see this here. There's Alice. Hi, Alice. How you doing? James is in where is that? That looks like James. Where is that? It looks like Catalina. Thank you. I had a brain freeze there. God, I've been there about 100 times. Catalina. James is in Catalina. Very nice. Mr. Hassey is in his office. Very exciting. All right. Okay, let's. I want to show you something, and again, this might be boring to some of you, but some of you maybe have never taken advantage of this. Part of your fees at the University of Laverne, and they do charge you enough of those stupid fees, I know that, is that they charge you for library services. And a lot of students never use these services, and you should. And one of the best things about Laverne is even after you graduate, these services are still available to you. All right, these databases, the library, these are all still available to you after you graduate. That's a good thing. So if I'm on this is the university website, which sometimes I disagree with because they only show traditional students. They don't show any working adults, which to me is a joke and a half, but I'll let that go for now and save my battles on that later. If I'm on the Laverne website, I go to the academics area. See this? I'm pointing my finger at academics and I go all the way down to the bottom to Wilson Library. Boom. I bring up Wilson Library. And there's the Wilson Library. I wonder if any of you have ever been to the Wilson Library. Oh, good. All right, that's a good experience. And in here is a little section on the library menu called Databases. I would click on Databases. And up comes all the databases that are in our Wilson Library site. And I would go, since you're a business student, to the Databases by Business and click on Business. The good thing about this is I'm recording this, so in case you don't have to jot all this down. Couple of things to note on this page. First of all, this woman here named Linda Gordon, she is there to help you, the business student, the graduate business school, the student. Linda Gordon. You can email her by clicking on that. You can click on that and book an appointment either online or by a phone call, and you can call her. Her job is solely to help you guys find information. She's our business librarian. She's a friend of mine. She's very good. And if you are doing a paper or a case study and get stuck on research, or Mr. Hassey's got me finding this thing and I don't know where the hell it is, you can call or contact Linda Gordon, and she's working from home. I know because I teach with her husband. She's working from home, but she's has access and she can help you. Now, and that also you can contact me and I will help you. But if you don't want to contact me and you're looking for help with research, doesn't even have to be in this class. It can be anything. Linda Gordon is your contact person. So there she is right there. Now, what database are we going to use? It's right here. It's called DB Hoovers. All right. This is a brand new database that I particularly like, and it's called DB Hoovers. And what you have to do is you click on that, DB Hoovers, you click on it, and up it comes. Now, for many of you, yes, up will come a screen and you'll have to log in. I'm a professor. I don't have to do that. But you have to log in. So the library has to make sure, hey, Yvonne paid her bill. She can get into the services. Okay, good, Yvonne. So what you have to do is type in your last name and your student ID number. Type in your last name, and do you know your student ID number? If you don't know it, I have it right here if you want to know it. All right, Yvonne, hang on, let me get it here. I got it right here somewhere. Where is it? Oh, here it is. Not that we're giving out top secret information here. Yvonne, your student ID number is 11901300. Jesus, your student ID number is 1-800 I need help. Sorry. See, I got you there. All right. So Yvonne, did that work? Amazing. I can't believe I gave out Yvonne's ID number over the internet. That's crazy. Yvonne, if you get hacked or something, blame these other individuals in our class because I won't hack into you. All right. So, all right. So there you are. So up comes this database and it gives you a bunch of propaganda stuff. So I get out of that. I clean out of that. I clean out of this. And what right up here, it says search for a company. All right. So you type in your company. All right. I'm going to use General Motors. So I type in General Motors and up comes every General Motors company in the world. And you want the very one at the top of the list, the one that's traded in America, USD, it says, US Stock Exchange. Click on that and up comes everything you wanted to know about General Motors, but were afraid to ask, or any of your companies. So you can do this, Jesus, for Home Depot. Angel, you can do this for Nike. Roman, you can do this for American Express. James, you can do this for 3M. Yvonne, you can do this for Microsoft. Michelle, you can do it for Johnson & Johnson. Thomas, you can do it for Boeing. Alice, you can do it for Walmart. And Darlene, you can do it for Coca-Cola. And it gives you everything you ever wanted to know about this company. Matter of fact, too much information, if you ask me. All right. But what you want to do is you're going to be looking at right down here. You're going to be looking at financial statements. So you bring up the annual financial income statement for General Motors or for whatever your company, and up it comes. December 31st, 2019, here's the income statement for General Motors. Then all you have to do is right here. You can click, it will print it out for you, or you can download it to an Excel file. How about that one? You can print it out or download it to an Excel file. Now, all these numbers are in millions. Millions. So when it says the operating the operating revenue for General Electric is 137,237. That's $137 billion. Ouch. You have to add 6 zeros to it. It's in millions of dollars. All right. So here's the net income for General Motors. Gives you for the last 2 years. You can print that out. Then you can go to the balance sheet. There's the balance sheet for General Motors. Their current assets, their long-term assets, their current liabilities. Look at that. Pretty cool. You can go and print that out or download it to an Excel spreadsheet. Then it gives you, which you probably won't need, you won't need this for case number 2, the cash flow statement. All right. So there are the financial statements for your company right there, right up to date. These are the SEC filings of General Motors. These are their actual financial statements, not ones you see in Yahoo Finance or Google Finance. These are the government filings by these corporations. All right. Now this goes to Michelle's question a little bit earlier. Where in the hell are the industry averages? Oh, I got a couple chats here. Let's see. I'm not going to tell you about the betas. I'm not going to tell you about the betas, but I have a feeling they're here somewhere. But if you want a quick and dirty beta, just go to Yahoo Finance that we did last week. In 2 clicks, you're there. All right. This is a little bit more substantial. Okay, but good question. Now, here we are. Right here, we can go to competitors. And it'll list all the companies that General Motors competes with. There's their competitors, if you're concerned about that. All right. You go here to industry overview. Industry overview. And it gives you all the different industry indicators of the industry that they're in. This is not the one we want, though. I'll show you that in a minute. All right. That's industry overview. Okay. You can go to quarterly industry updates, and it'll give you industry updates of what's happening in the automobile industry. No big deal. Some of you might be interested in some of this stuff. Let's see, where else am I going here? For any of you thinkers out there, it gives you a SWOT analysis of the company. Right here. Every company, it gives a SWOT analysis of the company's strengths, weaknesses, opportunities, and threats. Pretty cool. That's kind of fun. If you go down here to where I lost, financial information for the industry. Here we go, Michelle. This is where we're cooking. You go to industry information to financial information, and it gives you a little nice little graphs of key indicators, but this is the stuff you want right here. Here we go. All right, it gives you industry averages for financial statements, but also it gives you little parameters about what the industry, now they break the industry down into large, medium, and small, but here's the all. This is all the industry averages for sales, for balance sheet items. Now this, and here we go, financial ratios. Current ratio, there's the industry average. All right. Days sales outstanding, there it is right there. All kinds of information. All right. Current ratio, current liabilities to inventory, total debt to total net worth, all kinds of indicators, inventory turnover, blah, blah, blah. It goes on and on and on. Lots of information there. Now, again, you do not have to do this for your companies, but this is where I'll go get that information for your company that I'll provide you for industry average. That's where it is. All right. But again, if you're thinking about, you can use this. I use this all the time to track companies I'm thinking about investing in. This is up-to-date financial information about everything you wanted to know about a company. Industry, their financial statements, competitors, SEC filings, 10Ks. What makes up, here's a corporate summary. It gives a description of the company, where they're located. All kinds of information. Who's running the show? How much they make in salary? All right. So again, this DB Hoover's database is something that you can use in other classes. You can use it in your personal financial study, and it's a good source. Everybody raise their hand. Has anybody ever used this before? All right, so this is helpful. This is good we went over this. All right. But the key thing, remember, if you get stuck or you can't find anything that you're looking for, Linda Gordon is your key. Linda Gordon is your key person there for that. Okay. So this is something any MBA student should be aware of. And I shame on any professors who you've had in the past who haven't told you about this. This is nuts. My very first class of an MBA student, this is where I go to first. This is where the data is. And anybody who's a graduate student should know how to research data. Yes, Yahoo Finance is good for quick and dirty things, but if you really want to get the meat of a company, the meat of an industry, this database is available. Yes, and James brings up a good point. Wilson Library has a 24-hour chat. Now, I wouldn't call at 3 in the morning because there's nothing worse than talking to a drunk librarian. But at 3 in the morning, you got to watch out for that. But besides that, yes, James, thank you. They do have a 24-hour helpline. Yes, it's more fun to call at 3 in the morning. That's right too. But yes, they are available. Linda Gordon's not there at 3 in the morning. I know where she is. She's at the pool hall. No, don't tell her that. But she's at some other place. But besides that, you guys have access to all this information, and this is important stuff. So we're going to be using this a lot in our class. We're going to be using this a lot. Exactly right, Michelle. It's a good way to swift through annual reports, look at the company's history, look how they're doing, comparable to so many different things, and just get a basic overview. You know, there's 468 small companies within General Motors. All right. So again, this is all you need to know. And so it's through the database, DB Hoovers. There's Linda Gordon. So again, if you have any problems with that, you can also contact me. I know I've done a lot of work with DB Hoovers. It used to be called Hoovers. Then they went bankrupt, and then Dun and Bradstreet brought them out. If anybody know who Dun and Bradstreet is, D&B, they bought them out and now have taken them over and brought them back even better. This is the best business database, and you guys have access to this. I mean, Yvonne, you can look up a lot of secrets about Disney on this thing. I'll tell you, trust me. You probably already know them anyways. But so that's this is a good thing to use. And going forward, take advantage of this, please. All right. All right, let's move on to our next subject. If I can find it. Hang on. Ah. There's another file that I will be showing you. Just a sec. Here it comes. This is a good file that I will be posting after our class tonight. This is my lecture on Chapter 9, this file right here. It's called Week 4 Cost of Capital Review. All right. This is the definitions that you need to be familiar with that are talked about in Chapter 9. Okay, we're going to go through this. The reason I put it on this spreadsheet is because I read through the chapter last night, and I've read through this chapter, good God, at least 100 times, and Chapter 9 still confuses me to this day. All right, it still confuses me to this day, and that's why I don't make it a priority of having this textbook for our class. I think in some areas they make it more confusing than it is. But also, this is what Chapter 9 is all about, the cost of capital. Remember, there are 3 sources of capital a company can legally use: debt, equity, and profits. Debt, equity, and profits. What are the costs of those to use them to the company? The combination of those costs equal what is called the weighted average cost of capital. All right. And that's what Chapter 9 is all about, to come to this calculation. What does it cost us for debt in the company? What does it cost us for equity in the company? And the combination of those two, based on the percent of the capital structure of those vehicles, gives us our weighted average cost of capital. Ladies and gentlemen, Madame and Messieurs, you are going to be doing this calculation for your specific company next week in case number 2. You're going to be determining their cost of debt, their cost of equity, and guess what? You've already determined their cost of equity last week in the case, the required rate of return. If you've done that correctly, and I haven't looked at them yet, but if you haven't done them correctly, you will do them correctly after I give you the solutions. We're going to determine that cost of equity, and you're going to determine the weighted average cost of capital for your specific company in next week's case number 2. Those are the 2 main problems of the case next week, and this gives you plenty of time to plan for it. You're going to be doing a financial analysis problem of your company, which we just went over, and you're going to be doing a weighted average cost of capital analysis of your company next week. I will give you some instructions in the case of how to go about doing this. I will give you some industry indicators, which will help you. And you are going to be doing these calculations and then telling me and explaining to me what they mean. But you have over a week to prepare for this. There's no graded, the only graded work this week is the discussion forum, which I'll talk about in about 45 minutes. So let's go through this. First of all, let me get a sip of water. Okay. And remember, I am recording this, so you guys always can go back through this. Remember, the class recordings are on our YouTube playlist for our class on YouTube. And if you go to the the Zoom YouTube links file folder in Blackboard, you'll see a link in that file folder that you can click on, and it goes to our YouTube playlist to play the class recording. So you have those classes recorded that you can go back and look at. So first of all, remember, as I said earlier, the capital structure of a company, let me type that out again. The capital structure of a company is assets equals liabilities plus equity. All right. Liabilities are made up of current and long-term interest-bearing liabilities. Equity is made up of common stock, could be preferred stock for some companies, and the retained earnings or profits of the company. In Chapter 9, we're learning how to isolate the cost of debt and equity. The cost of debt and equity. What does it cost us in a percent? And then we're combining those by what percent of our company is in debt, what percent of our company is financed by equity. That's what is called the weighted average. So we need to understand what the capital structure is of a company so we can do this work. So one of the first things I'm going to let you know is next week when you do this for your, like the cost of debt for your company, let's say somebody has Home Depot. Jesus has Home Depot. Home Depot has many different types of debt. It's just not one amount. That's why this gets a little complicated. But again, I'm going to give Jesus the average debt interest of the company so he doesn't have to look up all the debt positions of Home Depot. So I'm going to provide that information for you. In the case will be an individual page for each one of you, giving you the given assumptions of the company, and then you're going to piece those together with your knowledge of how to calculate these and come up with the answers and the interpretation. All right. I will provide you with a lot of the assumptions, like the company's tax rate, like their average cost of debt, like their current market return. You'll have to look up the beta and certain things like that. It's putting these pieces of puzzle together and then calculating and formulating the information. That's how we do this. So let's look at this example. We're going to concentrate on this section here right off the bat. Let me highlight it. It's the cost of debt. In this example, the cost of debt, the interest of the company, their average interest on their debt position is 10%. Their debt is costing them 10%. Their company's tax rate is 40%. That's their average tax rate. Now, when I give you the tax rate at 40%, that's the combination of federal, state, and local taxes on income. It's not property taxes. It's not sales taxes. It's not payroll taxes. It's tax on the income, the profits of the company. It's federal, state, and local. It's almost impossible to get that rate on your own by looking at their financial statements. You can't get that. I will provide that for you, all right? But that's the combination of federal, state, and local. Many companies pay local income tax in certain states. Los Angeles, New York City, Boston, Chicago. If your headquarters are in those cities, you got to pay a local tax on income. That's why so many companies are headquartered in Texas, headquartered in a lot of financial institutions are headquartered in North Dakota. No local tax there, but that you don't have to worry about that. So if I wanted to determine the cost of debt for this company, I would have to know their interest on their debt and their tax rate. And I would come up with what is called the after-tax cost of debt. And that is the interest rate, or another way of putting it, the current yield on their debt, the current cost of debt, times 1 minus the company's tax rate. The interest rate times 1 minus the tax rate. The tax rate is 40%. That means 1 minus 40% is 60%. Their company's after-tax cost of debt is 10% times 60%, or 6%. In this example, that's what it's costing this company after taxes, their money, their debt. 10% less the tax that they can deduct as interest expense. And that is set by the company's tax rate. So yes, they're writing checks and they're paying 10% on their debt, but then on their tax return, they can write off 4% of that. So their true cost of debt is taking into account the deductibility of interest, or 6%. Thought I had a chat, but I didn't. Sorry. So see that? There's the calculation. It's pretty easy, really. It's the company's cost of debt after taxes is taking into account the tax deductibility of the interest. Thus, their after-tax cost of debt is 6%. That's their true cost of debt. Not 10, but 6. Everybody see that? Thumbs up. Cool. Okay. Pretty easy there. That's not that difficult. Now, the cost of equity, again, is what we did last week. The cost of equity is the required rate of return on the equity of the company. The required rate of return on the equity of the company. That's the capital asset pricing model. That's what you did last week in case number 1, the capital asset pricing model. For this company, the risk-free rate is 1.75%. The market return is 8.5%. The company's beta is 1.5. We've done this before. So the cost of equity, or the required rate of return on the equity position, in other words, if I'm investing in stock in this company, what should I receive as a return based on the risk and the market indicators in the market today? Well, remember, it's the risk-free rate plus the market premium, which is the market return minus the risk-free rate, times the beta of the company. So the calculation is 1.75% risk-free rate plus the market premium, which is market return, 8.5 minus the risk-free rate, times 1.5, which is the beta of the company. Do the arithmetic. It's 1.75% plus 6.75% times 1.5. Add them up, 11.88%. You might want to try this in your review for next week. When I post this spreadsheet, you might want to try that, see if you come up with 11.88% as well. So it's that simple. You've done this before, the cost of equity. Let's highlight this area here. And the new twist is this cost of debt. Now we're going to combine the 6% cost of debt and the 11.88% cost of equity to get our weighted average cost of capital. Now, what's the company's capital structure? Remember, the capital structure is the liabilities and equity that produce the assets that produce the revenue to pay off these things. What's the capital structure? Well, in this problem, the company has 44% debt and 56% equity. 44% debt, 56% equity. That's 100%. That's how the assets are funded. So here it would look like in this equation, 100% equals 44% debt plus 56% equity. That's their capital structure, 44 and 56. 44% debt, 56% equity. So now the weighted average cost of capital is the weight of the capital structure times the after-tax cost of debt plus the weight of the equity position in the capital structure times the cost of equity. And here's the calculation here. 44% capital structure times 6% debt, 2.64%. 56%, the weight of equity in this company in the capital structure, times the cost of equity, 11.88%, 6.65%. The company's WACC. The company's, here's another way, the WACC, the cost of capital, the hurdle rate. Many companies call this opportunity cost. I spell that right? Who cares? Opportunity cost. Those are different names for it. This is our cost of cash. It's our cost of money. 9.29%. And it's based on after-tax cost of debt, capital asset pricing model, cost of equity, required rate of return, the capital structure of the company, 44 and 56%, weight times cost, weight times cost, add them together, 9.29%. So if I would go to Jesus in case study number 2 and say, Jesus, brother, what is the WACC of Home Depot? Mr. Hassey, no problemo. I got you covered. It's 9.29%. That's not the real, so don't write that down. Or if I go to Michelle and I say, Michelle, what's the cost of capital or the hurdle rate for Johnson & Johnson? Mr. Hassey, are you being funny? It's no problemo. It's 8.75%. Well, thank you, Michelle. You're exactly right. If I go to Thomas and say, Thomas, hey, brother, what's up? Boeing, talk to me. What is the cost of the cash? What's the cost of the cash for Boeing? Mr. Hassey, really? You got to really ask me that? It's 6.2%. That's what you're going to do next week as part of your case study. Because what that does is that leads us into case study number 3 and case study number 4. This information builds on each other to determine the strategies of managing the assets of the company. And these are the calculations you have to do. This is what all of that razzmatazz in chapter 9 is all about, determining the after-tax cost of debt, the cost of equity, required rate of return, understanding what the capital structure is, and bingo, coming up with that information. Study this page, you are okay. And I will be providing some of this information to you in your case. Others you're going to have to track down yourself, like beta, like a couple other things. I won't disclose those at this time period. But you'll put this puzzle together, and then you're going to tell me, then I'm going to say, I'm going to give you the industry average of Home Depot. I'm going to give you the industry average of Nike and American Express. And what does this tell you, the cost of capital in relationship to the industry average? And here's one answer you will give. Let's say the industry average for this company is 8.25%. That's the industry average. Then you would say, after you came up with the 9.29%, Mr. Hassey, it's as simple as this. The risk for my company is greater than the industry. The risk for my company is greater than the industry. My company is riskier than the industry average. It means their cost of money is more expensive due to beta, due to their capital structure makeup, whatever. That's one of the possible interpretations of that answer. I'm going to give you the industry average, and what you come up with, you're going to say, what does this tell me about Home Depot? What does this tell me about Microsoft? after you do this analysis. You will become strategic MBAers, taking a look at interpretation of data and comparing it to the industry and what, not only that you did the calculations, bravo to you, but more importantly, what does it mean? If I'm this company and I need capital, it's going to cost me more. That means I got to make more profits to pay it off. If I have cheaper money than the industry, let's say the industry average is 11%. That means I have a competitive average because my money is costing me less than my competitors. I can sell my product with less margins because I don't need to make a big profit than my competitors. I can outcompete them. Welcome to Amazon.com. Welcome to Walmart. Welcome to Costco. Their money is cheaper. They can kick Radio Shack's ass. They can kick their competitors' butt. Excuse my French, sorry. All right. That's a key thing for strategy. If we have cheap money, we don't have to charge and have bigger operating profits. We don't need them. Our money is cheaper. This sets our beginning of our discussions going forward in this class. This is huge in finance. Is our money cheaper than our competitors? If it is, we can kick their butts by offering lower margins. Why do you think Walmart kicked the butt out of every little mom and pop business in the world? Their capital was cheaper. They could make less margins. Thus, why do I need to go to mom and pop in my village, in my town? I'll go to Walmart. I get the same product 20% cheaper. There you go. Now we have another thing going on now in the world. Oh, it's not a question of the cost of money. All money is cheap now. It's a question of where are our customers? That's a discussion for us next week. But what are we going to do now? We know our money's cheap, but I got to get revenue. I got to get income. That's up to Mr. Trump. That's up to our politicians. That's up to the economy. When are we going to let things loose so we can get back having people come to Disneyland? Boy, if I was Disney, Yvonne, I'm sorry to say this, after hearing what Governor Newsom and Mayor Garcetti said today, that we might not have any public openings of anything until January of 2021. That means no Disneyland till 2021.
That has actually already been discussed.
I bet it has, because you guys are a bunch of smart people.
Well, it's the logistics of, okay, if we decide to let people in, how do we
keep them safe?
Right. And what diligence, what duty do we have, to what extent? If we were to take everybody's temperature walking into the park, I mean, who's going to do that? Who's qualified to do that? And what if we have a family of 4 and 1 out of the 3 has a temperature? Then the whole family can't go in. I mean, it's just
crazy.
And then what happens is we happen to let people in, people get sick. Guess who gets sued?
You guys.
Right.
Yeah.
And it's amazing the number of ideas that we are getting into our company, because we handle creative submissions of ideas, including operational. The number of people writing to us telling us how we should open up the parks. It's coming from the public.
No kidding.
Anywhere from people having like tape across their forehead that measures their temperature as they're walking around. It's crazy, to sanitizing all the rides, like keep the rides open for 45 minutes, shut them down for 15 minutes, sanitize everything, open them back up, close them back down, sanitize everything. It's crazy. So it's going to be a long process for any type of mass gathering.
I read today that it's going to take, and I don't want to depress anybody. I'm glad I don't run a business anymore. I'll tell you that right now. But it's going to take 2 to 3 years to get this back to normal. 2 to 3 years. Yes, there'll be some easing. There'll be some, maybe Disney can open up to 1/10 of their customers on a daily basis of what they had before. Maybe they can manage that volume of people to manage and make sure they're safe. LeBron James, the Dodgers, USC football. I'll see you in 2021, guys. That's going to be difficult. Who wants to watch USC football anyways? They're a bunch of over. Okay. But again, the world is going to be changing.
And really quick, Dr. Hassey.
Yes, sir.
So the PGA is actually supposed to come back next month or in June is what they said without fans.
Well, with no fans, but also that's in Texas. Texas, they let you do anything. No offense. Try having the PGA Tour come to California for the PGA Championship in August. That ain't happening. So yes, they might be able to have some tournaments in some states where people don't think about this stuff. I'm sorry, I'm getting a political opinion there. I apologize. But at the same time, it's in, and you're right, Roman, I heard that today too. And in Texas, they'll get away with that. In California, in New York, in other states, they won't get away with that. So if yes, the PGA can play, but they're not going to be able to play their full tour in all parts of the country. And I agree with that. Major League Baseball, probably if they have a season at all, will be in Arizona. All the games in Arizona.
You were actually talking about having the games reopen for MLB, but just having the players play without the crowd there.
Yeah, but the bad thing about that is they still, in the schedule, they have to get on airplanes and travel to different parts of the country. That could be a little bit of a problem. So
yeah, but I heard that they were going to do a cactus league and a citrus league, and they were just gonna have
Florida,
them play
yeah,
at the spring training, so they just stay.
yeah.
Oh.
But then again, the players union is going to say, well, wait a minute now, you're going to keep these people away from their families for 6 months in a row, or what are the logistics behind that? So again, this gets more, like you just said about Disney and all the suggestions. This gets crazier and crazier. It's going to be interesting, and a lot of people have different opinions on that. And if I had children and if I had a family, I would want to make sure they're as safe as possible. And that would, me, I'm an old gangster. What do I care about certain situations? But if I had a family, if my kids were young now, I would say, no way, Jose, are they going anywhere if there's diseases and germs around? I'm not letting that happen. So again, there's a lot of things to discuss about that. I'm getting off topic. Sorry about that. But those are interesting things about Disney. And I brought Disney up, didn't I? All right. Thanks, Yvonne. So again, this is the calculation for cost of debt. Now, I want you to do this problem for next week. I want you to go to page 408 of your textbook, 408 of your textbook, and I want you to calculate the cost of capital for that problem. What is the WACC for that problem based on what we've seen here in this example? I want you to do this problem. I'm going to post the solutions on Saturday. All right? I'll post the solutions on Saturday. But I want you to try on your own this week. This is not for a grade, so don't worry about that. I want you to do on page 408, problem 9-15. If some of you do not have a textbook and don't know that problem, I will copy that problem and post it to Blackboard. Okay? If some of you don't have a textbook. But this is a good problem of practicing what we just did, determining the cost of debt, the cost of equity, and the weighted average cost of capital. Problem 9-15 on page 408. Try doing that problem, and I'll post the solutions this weekend, and then we'll talk about it in class next week. Okay? That's a good thing. So this will be posted after our class this evening to that work in class file. You have this, and try to do 9-8. I'll post the solutions this weekend. And then the other thing you need to do, I'm going to save this now before I get rid of it. Here's also what you have to do for this week. Let me bring it up. And I know some of you might say, Mr. Hassey, this is kind of a touchy-feely thing, but I think it's a good thing. And I'm concerned about everybody that has to do with University of Laverne. And this is a good thing I'd like you to do. Here it is right here. I'd like you to go to your Blackboard site. Some of you might have already seen this in the student discussion forums. And you'll see week 4 discussion post number 3, student feedback. And this is worth 5% of your grade. So you want to spend a little time on it. Here's the post. How has the coronavirus affected your academic studies at the University of Laverne? This includes online format, meeting your requirements for what you expect from your classes this spring term, and has your relationship with the ULV culture changed? Has your thinking about what Laverne is about to you changed because of this? Because you're not sitting in a classroom with Professor Hasse, you're online. Has that changed your relationship with Laverne? Whatever. I'd like you to post a one-page, double-spaced paper or posting to the discussion forum. This work is due next Tuesday at 6 o'clock. So you're going to create a forum, do a one-pager, and give me your opinions. All right? This is important. I want to know how you guys are feeling. This is kind of like midterm feedback, kind of like that email the university sent to you. I want to see how has the virus and how it's affected your studies. This format, how has that affected your studies, and how it has affected your relationship with University of Laverne. We've had some, I'm going to be honest with you, we've had some students in the last couple of weeks say, the hell with you guys, I'm out of here. But now they're finding out that when they said the hell with you guys, there's no other place to go. It's the same everywhere. If you go to a community college, and you guys are not worried about community college, you're graduate students, but if you go to another college, you still got to do online, and you're going to probably do online all through the summer. Nothing has changed in that regard in any other institutions. So what is your relationship? And maybe I've had some students tell me it just doesn't feel like I'm part of the university because of this online stuff. And that's okay to say. And maybe I'm not doing my job. Maybe I need to do better. So this is feedback that I would like from you guys. It's reflection. It's honest reflection. Got a chat here.
Can I ask a question?
Sure.
And because I have some friends who are students who are taking or should be taking their capstone.
Yes.
Right now. And I'm looking forward to that probably this time next year. And if what we say is going to be true about, this not being over, this pandemic for a long time, are they able to do the capstone online?
Yes, there's for about the last 4 years, there's been a capstone online class.
Okay.
So the two teachers who teach that have been doing it for more than 4 years.
Okay.
But to go back to your concerns there, Yvonne, let me be honest with you. The university is definitely going to have online classes this summer. Okay, they're definitely going to have that. But after the summer, it's clearly up in the air. We're waiting to see. The key period is through May 15th. What does it look like in our communities through the middle of May? And if things are beginning to loosen up, maybe we'll have classroom classes in the fall, okay? If I'm going to be frank with you, I'm going to give you my interpretation of this, and in my opinion, I think there's a 50-50 chance of having in-class classes next fall. I think there's a 100% chance we'll have it in January of 2021. I think there's a 50-50 chance, and I think that can be said for every university here in Southern California, 50-50%. It all depends on how loose yes, we won't be able to go to sporting events with 50,000 people. But if we go to a classroom with 10 students and they're socially distanced or comfortable in that environment, we'll do it.
Okay, so that kind of leads me to the next question. And I think a lot of other students might be interested in hearing this. For summer, usually it's incumbent the number of classes that's offered based on the availability of professors to be in class and the number of students. So will they offer more? Will there be more availability of classes now that they're just going to be offered online?
If the volume is there, yes. That's why you need, probably within the next couple of weeks, is to get a hold, or maybe your academic advisor will get a hold of you and say, okay, Yvonne, okay, Jesus, okay, Michelle, okay, Thomas, Raymond, whoever. What do you want to, are you still interested in taking a class this summer to speed up your graduation rate? Here's what you have to take. This is what's available now. But if I get 3 or 4 or 5, 6 students saying, hey, let's offer this course, they'll offer it. Okay. the university's not stupid. They need revenue. And they're not going to turn away students if they need the classes. And there will be faculty to do that. So it depends on the volume. If enough students are in that position to say, oh, can I take this class in the summer? You work that out with the academic advisor. Then what the academic advisors do is they will tell their director, and then they'll set the strategies for the summer. Okay. I was going to teach Business 500D. This doesn't do you guys any good, but I was going to teach 500D this summer at the College of Canyons campus, which is in the Burbank region. But as of now, that class definitely will be online. And also it's a question of how many students will be available. I think there probably will be a lot of students for that class. But be that as it may, it's all driven by volume. If there's enough interest in a course, they'll have it. Trust me, they're not stupid. But at the same time, it will be all online. Yes, Yvonne. But as far as the capstone class going forward into future terms, that's already been part of our online courses for years. I wouldn't worry about that. But at the same time, some students, and you know this probably now, maybe your feelings will change as we go through this term, but a lot of students say, all right, this is a good for one time only, but I don't want to do this again. All right, that can be, I understand that. We all have our own tastes and ways we like doing things. So that's not a problem. But so we'll just have to see what happens. And just to be between you and I think there's a 50-50 chance of yes or no on in-class classes this coming fall. It's up in the air. So that's where we stand on that. Okay, so I would like you to do this this week, and it's due Tuesday. This is your graded work for this week. I want you to look at problem 9-15, and I'll post those solutions this weekend. That's kind of like a study for the case number 2. And also, it wouldn't be a bad idea, guys, to just get that financial information for your companies by going to Hoover's and printing out the financial statements, printing out the balance sheets, so you have, or downloading them to an Excel file or a spreadsheet file, and begin to get that data, because you're going to need that data to do your answers of the case study 2 next week. So you might want to do a heads up and get that all done this week when there's less pressure, and then you have that information ready to go next Wednesday when I give you the case. Fair enough? Okay. Let's see. Where am I here in my timeline and what's going on here? Oh, yes. Let me now bring this up, and then we're done. Our chapters next week, and I'm going to go to the week 5 in advance here, is capital budgeting. All right, capital budgeting. There's some very good videos in YouTube you might want to watch before class next week. I'm just pressed my mic off here, excuse me. There's some good videos in our YouTube playlist for Business 635 about capital budgeting. You might want to take a look at that. Here's what we're doing next week. We're taking a look at, okay, we now know what our WACC is. We now know what our cost of capital is. Now we got to select what assets we're going to invest in with that capital. Are we going to buy a building? Are we going to create a new product line in Nevada? Are we going to invest in a new plant in Mexico, in Europe, in San Dimas, wherever? Where are we going to buy the assets to create a return that's going to be greater than that cost of capital? The strategy is, where do we invest that money to get the return? The return has to be greater than our cost of capital. And it's called, the analysis and the strategy to do this is in chapters 10 and 11. It's called capital budgeting, creating cash flow estimates of assets. And it requires, one of the reasons why you have to have a little of accounting experience to coming into this class is you have to know the definition of cash flow. What's the definition of cash flow? Net income, revenue minus expenses, minus taxes, net income, plus working capital requirements, plus depreciation add back, plus salvage value of the investment. Those net out to what is called cash flow off an investment. Net income plus depreciation plus or minus working capital plus salvage value. Now I know a lot of this sounds Greek to you, but if you've taken 500D in the last year, some of this might ring a bell. If not, that's what we're going to learn, how to determine cash flow off an investment, how to determine whether an investment in an asset is viable based on our cost of capital and the revenue or the cash flow to be received off that investment. Where's my phone? In 1998, here's my phone. You can't see it because of the, there it is. In 1998, Steve Jobs came up with the idea of building this phone. He asked his research R&D people, what's it going to cost to get the iPhone to market? And they told him, are you crazy, Steve? We don't even have the technology yet to do this. We know about some things, but we don't know how to keep the battery from burning up. That was one of the big technology things about the phone, the cell phone. To power it, the battery would burn up in your hand, and it still does in some versions. How do we fix that? Well, Steve Jobs said, all right, just give me an estimate. What's it going to take to build this, to create this technology and do this? His people said $2.5 billion. Wow. Now, in 1997, $2.5 billion for a company like Apple was like somebody coming to you today and say, hey, you want to buy a house? It's going to cost you $50 million. You're crazy. I can't afford that. Same conditions with Apple. But Steve Jobs, this is what a visionary he was. He was kind of weird too, but he was a visionary. He said, do it. Do it. Do it. Because he knew this was the product that was going to change the world for Apple. It was going to create a whole new industry. And it has. He knew that. He knew that before he died. And they went out and spent $2 billion to create this sucker. Create the technology, create the distribution network, create the advertising. And in that return, it has generated $40 billion of profit. 40 billion on a $2.5 billion investment. Pretty good call by Mr. Jobs. But at the same time, companies like Radio Shack invested $1 billion in creating an online network to compete with Amazon, to compete with Target, to compete with Walmart. And of that $1 billion investment, Radio Shack has only returned $300 million. Now you know why Radio Shack's not around much anymore. So a lot depends on the product. A lot depends on the management and the strategy involved in that product. And a lot depends on whether those numbers work. In chapters 10 and 11, we're going to determine whether the numbers work. It's called capital budgeting. And that's what we're going to study next week. But before we get to that point, let's make sure we understand the cost of capital. Let's make sure we understand how we go forward into that by reading about that in chapters 10 and 11 and looking at some of those videos in the playlist. And also there's a great video here in week number 4, our week this week, at the very bottom, capital budgeting overview. Take a click of that video and give you a good idea of what you're going to be reading about in chapters 10 and 11. So here's where that's where we stand for this evening. Again, your only graded work this week is the discussion forum, and I'd like you to volunteer and try to do that problem 9-15, and I'll put the solutions up on Blackboard. Remember, we have our office hours every Friday afternoon from 1 to 3. Yvonne was gracious enough to call me last Friday and talk about some things. So I'm available Friday afternoons from 1 to 3. I know some of you are working, but I'm available if you have any questions or concerns or issues. It might be a good time if you maybe before Friday afternoon, if you can do a quick thing on DB Hoovers and see if you can find your companies, find the information. And if you have any problems with that, you can come on with me Friday and we can solve those issues. Make sure you get that information. Now I open it up to questions from our distinguished audience. Folks, any questions?
One last question. Would we have our case studies graded in time for your office hours?
Yes, the case study grades will be up no later than Friday morning. Hopefully
Okay.
they'll be up tomorrow. It depends on when these our other postings are made, but I will get those up before the session on Friday afternoon. Yes.
Okay. Thank you.
Okay. Anything else? Darlene, you okay? Roman, you okay?
Doing wonderful.
Angel, you're okay?
I'm good, thank you.
All right, I can see everybody else. I see some picture of James. I don't know where he went, but he looks like he's running for governor here in this picture. I don't know what this is all about. But James, you're okay? He's probably in the bathroom. He's okay. All right. All right, then I'll leave you. Again, remember, I've recorded this. I'm going to post the recording probably by tomorrow morning. It takes a couple hours for it to cycle out. So I'll post that tomorrow morning. You can watch it or go to refreshers. One of the nice things about these recordings is you can slide the recording to different sections of the recording. So if you don't want to hear all my mumbo jumbo at the beginning of the class, you can go to the end of the class or the middle of the class and just see that particular section, and then you're done with it. All right. Oh, James can't talk, and he just posted that chat. Can you let us know when case study is graded? I'm here, good to go. Sorry, I can't talk. No, I don't buy that. You just don't want to talk to us. Okay, no problem. James, as I said to Yvonne, it'll be up by Friday morning. Thanks, everybody. Be well, be safe, and we'll see you all next week or on Friday. Adios.